Hi everybody, my name is Alina. I'm a chartered accountant and I'm a freelancer. I work from home. I am a CA, but still I do not do a job, neither do I own a firm. So this is something different, and I make money sitting at home using different methods, and that is what my videos are all about. So if you want to be staying connected to me and to my journey and figure out how exactly I made it in the long run, please subscribe to the channel and please like and share the video if you like it. Today's video is all about mutual funds and fixed deposits. Okay, and this video is going to be a complete English video because I make videos in English and Hindi, but this one is going to be in English. Maybe I will consider putting in the subtitles later, or maybe I will make this video again in Hindi, but for now this is going to be in English. Okay, so let's get into the video. The first thing that comes to our mind when we are putting in money into a mutual fund is the risk that is involved in a mutual fund, which is definitely not the case in fixed deposits. When we are putting in our money in fixed deposits, we know exactly the duration and the amount of interest that we are going to be earning on that money, right? So that gives us a little peace of mind. But in case of mutual funds, your money is it does not go into the fund with a sure return, with a sure amount of the rate of return I'm talking about. So of course, there is a certain risk involved. So that is why whenever they advertise their mutual funds on the TV or on the radio or wherever, they always have this disclaimer that mutual funds are subject to market risk and all that stuff. But the thing is that, your money is handled by highly professional and experts of that field. So when you put in your money into a mutual fund, there is a fund manager absolutely trained and well qualified to handle your money. Okay, these people are the experts of their field. They will never take the wrong decision with your money. So in the short duration, yes, the money might, the NAV of the fund, the net asset value of the fund might go down or up, okay, but in the longer duration, everything gets averaged. Okay, so even if during some year there is a fall in the money, so I would say in 2018 most of the funds were not performing very well because there were certain change in the rules of the income tax, and there was some categorization that had been done. So yeah, things had gone a little bad for the mutual funds. Why? Because of the government laws and the rules that had come up. Okay, so that particular year the funds were not really performing very well, but they picked up real quick, and many of the mutual funds are performing nice now. So coming back to mutual fund managers, these people, I will give you a couple of names. So there is Mr. Nilesh Surana, absolutely famous for his skills for managing the funds, and then there is Mr. S. Krishna Kumar. Okay, and apart from that, there is Janki Raman Rengaraju. These people are so famous and they are working with different funds. So my point over here is not that just these people, but there are many such people who are working with a lot of funds, and they are doing a very good job with your money if you put in your money into a mutual fund. Okay, so in my opinion, ever since I have started investing in mutual funds, yes, there was a duration of roughly 7 to 8 months when my NAV, my growth of the mutual fund was absolutely negative. Okay, it was all a low for a very long duration, like 7-8 months, but it picked up, and trust me, ever since it has picked up, it does go down sometimes, okay, but then it always manages to come back up. So my point is that 2-3 things you have to consider. First, there is a fund manager. Okay, then second, the very important thing that you have to consider is the time duration. When you put in your money for a longer time duration, the fluctuations in the money, they average out, okay, and they end up giving you a good result. And the third thing is that there is SEBI. Okay, so SEBI is the governing board which has been appointed by the Indian government. SEBI regulates the mutual funds. So nobody can run away with your money. That is not going to happen. SEBI regulates these funds. SEBI has, it's like the monitor of the class, okay? It it always has its eyes on these AMCs. AMCs are the asset management companies. So whatever funds you hear of, SBI Mutual Fund or HDFC or Axis Bank, these companies are called the AMCs. These are asset management companies. They manage the assets for you, and your asset is your investment. So that is why they are called AMCs. So first point, I think I've made myself very clear. Mutual funds, they do sound risky, but they are handled by professionals, and most of the times we do not have enough knowledge to make things work for ourselves when we put in our money into shares and the various other sectors, right? But these people have knowledge, and these people know what they are going to do with your money. They have the best team of advisors working with them, okay, and they take decisions collectively, and they are doing a fair, responsible job with your money. You can trust. Second point of differentiation is that FDs, they come with a pre-specified rate of interest, okay? You know what amount of interest you're going to be making, correct? There is going to be 7% or 8% or whatever percent it is. But on the other hand, mutual funds, their rate of return is fluctuating. It fluctuates along with the economy. And as, I don't know if you know or not, but India is world's fastest growing economy. If you really want to benefit from the growth of your economy, of your own country, you really need to invest some money into the shares, and you should not do it directly. Investing the money directly into the shares or stock would be a bigger risk. Why? Because you're not, I'm assuming that you're newer into this field. So I don't think you really have the kind of expertise it requires or the kind of knowledge it requires for you to take good decision with your money. So in that case, putting in the money into the mutual funds will actually help you gain from the growth of your economy, from the growth of your country's economy. So when India grows up and it goes up, the economy goes up, there is a boom, you also benefit out of it, because your money is invested with the companies which are actually responsible for the GDP of the country. Okay, so you don't do it directly by investing directly into the share market, you do it through the mutual funds, and that is where the fund managers are going to be taking decisions with your money, right? So second point of difference is simple. FDs have fixed rate of interest. Mutual funds, the rates, they go up and down, they fluctuate, and that is where the real game is. That is where you can actually gain something out of it. Third point of difference is that when you take your money out of a fixed deposit, that is the premature withdrawal, okay, when the period hasn't expired and you take your money out, what happens is you have to pay a penalty. And of course, when you pay a penalty, you again, you end up losing the major chunk of whatever you have made on your money by that time. So there is a penalty for premature withdrawal. On the other hand, when you talk about mutual funds, there is an exit load. You call it the exit load, okay? But that is mostly for the first 1 year. So if you put in your money into the mutual fund and you take your money out or you withdraw the money within a year, that is when you have to bear the exit load, which is generally 1.5%, okay? Maximum 2%. I don't think it goes beyond that, but it is somewhere in the range of 1 to 2%, okay? That is only when you withdraw within a period of 1 year or so, okay? So different funds have different durations. Most of the funds they come with 1 year duration for their withdrawal exit load, okay? So you would not want to withdraw the money within a year if you've put in your money into the mutual funds. But if you withdraw after that 1 year, there is no exit load. So that is also where you really gain out of putting your money into mutual funds, because you get to take the advantage of the higher returns, and at the same time there is no penalty for premature withdrawal. Another very important point of difference between fixed deposits and the mutual funds is the way they are taxed. And I'm sure a lot of you really want to know how is the two of them different from each other over here in this aspect. In case of fixed deposits, you earn an interest income, okay? So interest income is the portion that is going to be taxed under the head income from other sources. Whereas in case of mutual funds, you do not earn interest. Okay, what you earn is the capital gain that you make when you sell the mutual fund. So when you put in your money into the mutual fund, that is your cost. Okay, and when you finally sell it, whatever gain is the difference between the NAV. Okay, so if suppose I bought the mutual fund in 100 rupees and when I sold it, it was at, let's say, 230. Okay, so 230 minus 100, that is the 130 rupees, the difference, that is what is going to get taxed under the mutual funds, and it will go under the head capital gains. Okay, now let's talk about the details of how exactly interest income of fixed deposits it's going to get taxed. Firstly, fixed deposits get taxed every year. So whenever your interest is credited to your account, and in case that interest exceeds 10,000 rupees, that is when 10% of the interest will be deducted as TDS. Okay, and in case you have not provided your PAN to the bank, in that case it is going to be 20%. 20% of the interest income is going to be taxed, it's going to be deducted as TDS by the bank. So let's get into the detail of how exactly you will be taxed with the help of an example. If you suppose make 10 lakh rupees in a year, that is your income of the entire year, you fall in the bracket of 30%. Okay, so 30%, and if suppose you make 1 lakh rupees, 1 lakh rupees as your interest income, that is when 30% of 1 lakh, that is 30,000 rupees, and with 4% as the education cess, that is going to be 1200 rupees. So 1200 plus 30,000, 31,200 will be your taxation on 1 lakh rupees of your interest income of the FD in a year. And I've already told you about the TDS deduction. So in case your interest that is getting credited to your account is more than 10,000, you will be getting tax deducted at it at the rate of 10%, and if no PAN card, 20%. Okay, how can you avoid that? So there is this case where your total income falls within 2,50,000. Okay, so 2,50,000 is the exemption limit, and you do not have to pay any tax if you fall in the income group of less than 2,50,000. In that case, what you have to do is you have to fill up the form 15G. Okay, and form 15G will be filled up and sent to the bank by you. And in case you're a senior citizen, you will have to fill up form 15H. Okay, so I'm considering most of you watching the video will be not the senior citizens. So 15G is the form you need to fill up and send to the bank so that they do not deduct your TDS. Okay, and if you do not fill up your form and submit, they will be deducting TDS at your income, even if your total income for the year is less than 2,50,000. That is when you owe nothing to the government as the tax. Okay, coming back to mutual funds, how does it exactly work in the case of mutual funds? In case of mutual funds, there is a category of LTCG, that is long-term capital gains, and there is this category of STCG, which is the short-term capital gains. So let me tell you, there are broadly 2 or 3 categories. First is your debt funds. In case of debt funds, LTCG is 36 months. So you will, if you invest into debt fund, you will have to hold that fund, that money into the debt fund for a period of 36 months, which is 3 years. Okay, in case you withdraw your money before that period of 3 years, you will have to be paying the tax in the bracket of short-term capital gains, and you don't want that. I will come to that later. Okay, so LTCG is beneficial as compared to STCG. Why? Because STCG rate is 15%, but LTCG rate is 10%. Okay, so if you want to be falling into the category of LTCG for your capital gain that you make on a mutual fund, you would want to hold your mutual fund for at least a period of 3 years if you have the debt fund running for you. But in case of equity fund or in case of balance fund, this period of 36 months is reduced to 12 months. Okay, it's just a period of 1 year for which you have to hold your holdings, your units. So if you hold your units for 12 months in case of equity fund, that is when you will be falling into the category of LTCG again. So I will repeat myself, for equity and balanced fund, it is going to be 12 months for LTCG. But in case of debt fund, it's going to be 36 months, okay? And anything less than that in both of these cases, it's going to be STCG. And STCG is सीधा 15%, ठीक है? But in case of long-term capital gains, it's going to be 10% of whatever you make on your income. There is a way you can save your capital gain tax by investing into ELSS. ELSS is equity linked saving scheme. So these are again mutual funds in which if you put your money, and of course there is a holding period of 3 years involved. You will have to hold your money for at least, you will have to stay invested into the fund for at least 3 years. And let me be clear, these guidelines are for now. So tax system changes every year, so things might change, but for now this is what is absolutely true, okay? So if you invest into ELSS, you will have to stay invested for 3 years, and after that you can withdraw your money. For first 1 lakh rupees of the gain that you're making is going to be absolutely tax free for you, okay? And beyond that 1 lakh, it's going to be LTCG, but without the benefit of indexation. What is indexation and all that stuff, I'm not going to talk in this video because I know that will be like overpouring of information, which I don't want to do right now. So yeah, so you'll be paying 10% on whatever you make over and above 1 lakh of your capital gain. LTCG is far less heavy on the pocket as compared to STCG. If you buy into mutual funds, you would want to stay invested in them for 12 months or 36 months respectively if you are going to put your money into equity, balanced, or you're going to be putting your money into debt funds respectively. So watch for yourself. After talking about the taxation, let's talk about the wealth creation. If you want to really create wealth for yourself, even Warren Buffett says that the best way you can create wealth for yourself is by investing into mutual funds. Fixed deposits are never going to create wealth for you. Why? Because they will barely beat the inflation. Whatever you're going to make on a fixed deposit, that is, the rates are really less these days, okay? Whatever you are going to be making on fixed deposits, the interest income will barely match up to the inflation that is happening every year. So when you withdraw your money after 4 years, 5 years from the FD, that is when it matures, it will hardly earn you anything real, because whatever it will earn you will be as good as saying that it was just going into the inflation that has happened over the period of 4 or 5 years. So I don't think there is any point if you put in your money into a fixed deposit in order to create wealth. But yes, it's a safe measure, it's a safe deposit, and that is where you invest when you want your money to be 100% sure shot and nothing reducing in the period, and you still want to make some amount of interest. So fixed deposits is good in that case. Otherwise, mutual funds in the same period of 4 or 5 years can really give you a return of roughly 16-20%. There are a lot of such funds. If you do a little bit of research, a lot of such funds are there in the market which are on an average bare minimum giving you 12-13%, which is far above a fixed deposit. So the wealth creation aspect is definitely one point of major difference between these two. Another point is that fixed deposit investments are mostly for conservative investors. So if you have a conservative approach, which is not a bad thing to have, it is just playing safe. So in case you have a conservative approach, fixed deposits is your thing. But if you want to play it a little hard and you want to take, you have a appetite for a little risk and for a higher risk, mutual funds is your thing, because that is when you will be actually making very good money out of your investment. See, when you are a conservative investor, 6.7 to 7 or 7.5, maximum 8% is what you earn on a fixed deposit. But At the same time, your money is safe. You know that this is the minimum and this is the maximum that you're getting. But in case of mutual funds, the rates, they fluctuate. The returns that I'm talking about, they fluctuate with years. But because there is a risk involved, the return is also mostly good. Even if you make a 12% on your mutual fund investment, that is roughly 4 to 5% more than your fixed deposit income. And if you make a good choice and you invest after some amount of research and checking into the credit ratings of the funds and all, which is not very difficult these days. You just have to sit with your laptop or your computer for a while and talk to a few people who are already invested into these funds. I don't think it is going to take you more than a couple of days or a week to find out a good fund for yourself wherein you can put in your money to make some good amount out of. You have to remember that safety comes at the price of lesser returns. So if you want to play it conservative, you will have to bear the burden of lesser returns. Last thing that I would want to say over here is that, most of us are into jobs and most of us do not get the luxury of investing our time or our money into a business or trying out something new or venturing into something new, taking some risk in life. I think this is one place you can satisfy your hunger for taking risk, and I think this is a very important point that I'm making right now. You want to do something with your money and you want to try out something nice and you have that urge to take risk in life. I think this is the best place you can actually put in your money and let your money work for you. This is where you get a chance to actually take a risk without really quitting your job or taking a hit on your income. So that is just my suggestion. I think you would want to do your research in case you want to find out about good funds or you want to find out about where to invest your money into. There is this wonderful app called ET Money. Please go into that app and it will give you a very fair idea as to where you should be putting your money, and they will manage the money for you. And apart from that, then you have your money control. Money control app is pretty good, which will take you some time to actually understand how the things on or the features on the app work. Give it some time. Don't expect yourself to understand everything in the first day or a first week. No, it's going to take a while. It's going to take you roughly a month or so before you actually start getting a hang of the things, how exactly they work. I think I am mostly done here. I am a mutual fund person and I know it involves a little bit of risk, but as I told you, there is no gain without risk. Okay, and in the longer duration, if your age is not too much and if you have time on your hand, I think mutual funds is not risky. Things have been working well for Indian economy, so I would definitely want to take my chance with my money into mutual funds. So this was it for today, and I hope you liked the video, and please share your thoughts on the comments. I love reading your comments. I am a complete fan of whatever you write to me. I pick most of my video ideas from your comments. Give me some new ideas. Share with me what you want to make me talk on, and I will definitely write that down in my diary and I will come up with a nice video. I hope you like my today's effort. If you did, please like the video, share with your friends, take wise decisions with your money, and I will see you very soon again on a video. Till then, bye and take care.